It's in the multifamily business. I don't want to read this whole thing because we don't have enough time, but I'll share some things with you about Mr. Russell. MBA from the University of Texas, BA Cal State Northridge, CCIM, as I said, National Association of Realtors Commercial Group, California Association of Realtors, National Real Estate Investors, Commercial Association of Real Estate Investors. I can go on and on. Kevin Russell shares information with us today. Please step forward. Kevin Russell, please welcome him with me.
First of all, let me start off by saying thank you, Ben, and the association for inviting me to come and speak to you guys this morning. How's everyone doing?
Good, doing well.
Excellent, excellent. I'll try not to take up too much time, but there are a couple of key points that I do want to discuss and talk about. First and foremost, I want to start on a macro level, since I believe the majority of those of us in here are brokers, are representing clients. I think there's some items here that we need to be able to take with us and share with our clients. So there are a few things I want to talk about on a macro level. First and foremost is the health of our economy, future growth, governmental regulation, Federal Reserve tapering of quantitative easing, and then the employment and wage growth. Let's start off with the health of the economy. I think most of you guys have been following and tracking the news of late with GDP for 2013 coming in around 2.6, 2.7%. We actually need GDP to come in north of 3.4, 3.5, 3.6 for there to be any real tangible benefit or felt by consumers in the economy. Right now, 2014, we're looking at GDP coming in at about 2.9. That is the current forecast. It's not enough. We are headed in the right direction, but we need more stimulus and more growth to help spur our economy. Locally, economic growth is actually pretty good here in Southern California, specifically LA. We're looking at anywhere between 3 to 4% economic growth over last year. So we're heading in the right direction. Things are very positive here locally, but on a national basis, we still need more work to be done. Again, nationally, we're looking at somewhere between 2.5 on the low end to about 3% as far as annual GDP. I think the message out of Washington is slow to moderate growth over the course of this year. We do need more growth to come from the economy to help spur consumer spending. One of the big issues, not only is unemployment, but wage growth. And I'll talk about that in a second. Can you guys hear me? Because I don't want to use the mic. Hopefully my voice is carrying the swamp that we have here. I think probably one of the biggest issues that we're faced with in our industry is governmental regulation. And I think most of you have been reading and hearing about the future of Fannie Mae and Freddie Mac. Just to give you a little background and context, Freddie Mac and Fannie Mae provides liquidity for the housing mortgage market. You know, there's a lot of mortgage brokers here. They can attest to that. Those two GSEs provide a bulk of the housing mortgage industry financing, specifically for single family, but for multifamily as well. And it's key that their existence, as it has been in the past, continue to provide liquidity to the marketplace. There's a lot of draft bills being passed around. There's already discussion about phasing them out. Their commitments have started to drop. Last year, their commitments and mandate was to drop 10%. We're looking at anywhere between another 5 to 10% cut from their support and liquidity this year. What does this mean for most of us? It means that without the liquidity in the marketplace, deals don't get done. Plain and simple. Financing becomes difficult. Pricing values of assets starts to take a hit. There's other reforms taking place as well. There's banking reform, there's more oversight, accountability, and risk management that's starting to affect the banking industry. A lot of people talk about, well, the banks are not lending. Well, that's not true. It's that the banks are not doing stupid deals like they used to before the past recession. There's still a lot of money out there to be had. So the requirements, the qualifications are certainly tighter today. A lot of that is due to the tightening of their reform on the industry itself. Other reforms that we're likely to see coming from Washington over the next 6 to 12 months, 18 months, there's still a lot of talk about capital gains reform. There's a lot of talk about 1031 exchange reform, as well as the overall tax basis. There's even discussion about real estate investment trust tax reform as well. So there are a number of things that is targeted towards our industry that we need to be aware of that affects us every day. Even though the policies are being made in Washington, the effect is back here at home as well. And if there's any questions that you guys have, just to kind of keep this a little informal, please feel free to raise your hands if there's any questions. I don't want to wait to the end for you to bring up a question that I almost forgot about what I talked about. Yes, sir.
You mentioned that there will be, they're looking at reform on capital gains. What will those reforms be?
We don't know yet, other than what was already passed with 15 to 20% based on a certain income of individual. That's already in place. There was an additional healthcare tax added on top. So there's a number of places in which the government is looking to start to raise revenue. Tax reform in the real estate industry happens to be one of the places. So the capital gains is still on the table. I think Republicans are still fighting against it, but it depends on who's in office come next term. There still could be an attack on capital gains. Any other questions? I'm going to talk about the Federal Reserve tapering of QE, quantitative easing. Is there anyone that's not familiar with QE or quantitative easing is? So I don't have to bore you about what that is. Here's the Cliff Note version. The government, after the last recession, wanted to kind of spur the economy back to better health. One of the things that it did was start to buy bonds. Buying bonds pumped a lot of liquidity and capital back into the economy to spur the economy itself. Well, the government feels that they've done more than enough so far and ready to start tapering back. So you heard a lot of discussions about the Federal Reserve starting to cut their bond purchasing by about $10 billion per month. Well, just the announcement of that middle of last year sent the 10-year Treasury up almost 100 basis points. Okay, it came back down, and now during the first couple of months of this year, we see that the actual tapering is taking place. Well, that's going to have effect on 10-year Treasuries to a large degree. More importantly, it's going to affect mortgage rates. And as mortgage rates go up, in our industry as far as multifamily, cap rates go up. Cap rate goes up, values come down. So there's a lot of discussion looking at what's happening with the tapering of the Fed Reserves. But it's already in place, it is going to happen, but they wouldn't do it if they didn't think that there was going to be a healthy economy in front of us. So a lot of what spurred them to start the tapering was their outlook that the economy is starting to get back to better health. The thing is it happening fast enough? Because their foot is already on the throttle as far as tapering back. Now they said that they can ease up, they can cut that $10 billion back in a given month, but right now their commitment is $10 billion per month. As a result, we expect the 10-year to increase. There's been discussion yet about some experts believe that it's going to stay right around where it is right now. The 10-year Treasury is hovering around about 2.7 to maybe 3%. A lot of people are under the impression that the second half of the year, as more of the tapering starts to take its effect, that rate is going to start to increase. The 10-year Treasury is going to start to increase. And we're expecting somewhere between 3 to 3.5, possibly 4% rise in the 10-year Treasury between now and the next 18 months. That's a significant increase in the 10-year Treasury, which will result in higher interest rates as well. And again, that will certainly impact property values. Any questions on that so far? We're also facing, and this again is in the multifamily space, we're also facing the largest amount of mortgage resets in history that's about to take place between 2014 and 2017. Requiring most owners to start to refinance in a higher rate environment over the next 3 years, again, bringing additional capital to close. If not, they'll be looking at having to sell their properties. I want to touch on employment right now and wage growth. Employment growth right now is moderate and steady. We're seeing a lot of positive signs with our employment starting to improve. But the real issue is not employment underemployment or unemployment. The issue right now is underemployment and wage stagnation. Right now, wage growth is not happening as fast as we would like it to happen. Hence the reason why you see the government attacking the minimum wage, trying to get more money in individuals' pockets so it can help spread the economy, because again, 2/3 of our GDP comes from consumer spending. So right now, the issue is wage growth. Household incomes are stagnant. Well, again, unemployment is starting to improve, wages are not. There's a lack of real wage growth, which will limit economic growth. Hence one of the reasons why we're not seeing GDP being forecast above 3% for this year. One of the things, and well, is how it affects owners, is their ability to raise rents. And I'll get into this a little bit more in a second. But again, keep in mind, if individuals' household incomes are not increasing, particularly those that are renters, how is it that owners of apartments are going to be able to continue to push rents? They're going to reach an inflection point where they're going to start losing tenants, or they're just going to have where, people are starting to balk at the rates. They're going to have to hold them steady. Now, you complement that with an environment where interest rates are starting to rise. One way for owners to combat that is to raise rents accordingly. As the rents start to increase, even in a rising interest rate environment, the two can offset one another and you still have positive value. Well, we all know that interest rates are definitely going to increase over the next 6, 12, 18 months. But if we're reaching a point right now where owners can't raise the rents any further, then we're going to hit that inflection point where they're going to start to lose value. Again, it's not that rental growth is negative, and it won't be. It's still very positive. Right now, here in Southern California, we are looking at probably growth rates between 3.5 to about 4.5, upwards to about 5%. You say, well, that sounds pretty good. And actually it is. Again, it's still positive. But the problem is over the last 2 years, we were seeing rent growth anywhere between 5 to 8%. Those days are gone. We're not going to see that anymore unless the economy really starts to pick up, as well as wage growth starts to happen as well. If wages continue to be stagnant, owners are going to be hindered by their ability to raise rents. I'm going to talk about a little bit more locally, the local economy. Again, we're doing pretty good here locally as far as our economy. We're seeing projecting anywhere between 3 to 4% improvement this year over last year. Economic growth is trending in the right direction. Local growth industries and strong employment in media and entertainment, technology, healthcare, and hospitality. So we're doing pretty good here in Southern California. We're also benefiting from very attractive capital coming in from foreign countries. You have foreign capital coming in from Canada, Europe, Middle East, Asia. So we're in a very attractive place right now, but we still have a lot of capital inflow coming in. Talk a little bit about some of the apartment trends for 2014. Again, slow rent growth, we're looking at anywhere between 3 to about 4.5% this year. Again, a lot of that is being limited due to the wage growth issue. Vacancy on average is going to come in between 2 to 3%, depending on the submarket, asset quality, and location. 10-year treasury to increase north of about 3%, probably 3.5 to 4% by the next 18 months. Certainly north of 3% before the end of 2014. Increased construction. Now, we always say that LA is landlocked. There's not a lot of land to develop on. I don't know where these developers are finding this land, but they continue to develop. The biggest locations for development here right now in Southern California is going to be Hollywood, West Hollywood, parts of Santa Monica, Playa Vista with the runway being developed right now. Probably the largest market of development is going to come downtown. The thing is, with all that new Class A construction, the existing Class A's are going to suffer a little bit. They're going to take a hit with their vacancy, and the owner's going to have to hand out concessions just to compete for a limited base of renters that can pay those very high rents.
Kevin, you're talking about office segment, is that right?
No, multifamily.
Okay.
Multifamily. Yeah, you guys have heard of all the recent development in downtown LA with all the new multifamily. Now that the Staples Center there, LA Live, they have a couple of new grocery stores downtown. So there is an influx of people wanting to live downtown now, and so the building has already started. There's a number of properties that are coming to market this year, and even more that are already planned for next year in 2016.
Kevin?
Yes, sir.
I probably should have asked this a little bit earlier. You mentioned about the rental problems for us having the rental communities. Those investors like BlackRock and Red River, the ones who are coming in and buying all these homes, and they had a 5-year plan to resell them in 5 years. What do you think the market's going to do once they start even putting those properties on the market, or they sell those properties? Because it seems like what they're doing right now is they're holding for 5 years, and they're causing a rental state for a lot of people who probably should be buying homes.
Right. Right now, again, it's no big mystery that here in Southern California, the affordability of single-family home purchasing is extremely high. So it does force quite a few people into the rental market. As to BlackRock and some of the other private equity funds and hedge funds that have bought up all these homes, they're certainly looking to exit at some point. The key is, are they looking to exit all at once? Do they have the patience and the tolerance based on market dynamics to piecemeal and kind of chip off what they are currently holding right now? Those are two unknowns that I can't answer. It's not my expertise in a single-family home. But they are looking to exit. They do not want to be in a single-family home property management business. So they will be looking to sell. The question is, will the market allow them to sell and exit in mass? Are they going to have to chip away over a number of years? They're going to have to bring in other partners to buy so they can exit and go and invest elsewhere, and allow those who are more germane to the local market and single-family housing to actually take that on over a longer period of time.
Right now, that's an unknown.
It is a huge unknown. Any other questions? One of the things that I'm seeing, and maybe you guys can echo this to some degree, and that is there seems to be a little bit more of an appetite for risk. I have a few clients, and I've noticed that a lot more investors are looking to jump back into the Class C, B minus apartment types. A lot of them are chasing yield. Cap rates have dropped down to the floor in some markets, particularly on the west side, and for the Class A investor, they just can't compete. You know, a lot of the institutions are able to come in on cash, which is to your point, they're not getting any debt on a lot of those deals. It's all cash. But for the other standard investor who's maybe a private client, partnership, a small investment company, those guys are looking to change their strategy and their model right now to start going after some of the more urban infill territories and submarkets, pursuing apartments that maybe got a little bit of dirt on it, a little bit of hair on it, so they can go for more of a repositioning play because they're chasing yield. They want the performance, they want the income return. From buying at a cap rate sub 4%, there's no place to take it. How am I going to make money? Well, if you look on the west side, a lot of the deals over the past, I would say, 12 months have been trading sub 4%. So we're seeing a little bit of a shift towards more infill, more Class C, Class B properties. I have a client right now who's been looking on the west side for some apartments, multifamily. And he said, Kevin, I can't make anything make sense. They just don't pencil out. And I'm saying, you're right. You know, everybody wants what they want, but it just doesn't take a place for an investor. Where can you take this asset? He said, well, what do you suggest, what do you recommend? I said, you need to start looking a little more infill. He said, you have any markets in mind? I said, most certainly do. He said, what markets do you have in mind? Inglewood. Inglewood is probably one of the most best markets because of all the planned redevelopment and construction that's going to take place in Inglewood, let alone if we happen to get an NFL team. Because the Rams owner has already bought all the land. So I'm telling a lot of my clients, if you want to chase yield, if you want investment return, go and buy Class C, B properties in Inglewood. It's probably one of the strongest markets. They have a great redevelopment plan throughout the whole city.
Shh, stop talking about Inglewood.
some of the major threats, and again, this is for you guys to take back. I invite you to do your own due diligence and research on some of these issues. But some of the things that I'm making sure that I stay on top of when I talk to my clients and investors, the Fannie Mae and Freddie Mac reform, that's real, it's happening, it's coming. I know that the association probably has lobbyists in Washington that's keeping a watchful eye on the issue, but that is going to happen, and it will affect our industry. There's a lot of talk about unemployment and employment. That's not the real issue. The real issue is wage growth. They're not seeing wage growth happen as part of this recovery that we need to, for there to be any major effect on the economy. So keep your eyes on that. Rising interest rates. I mean, you can get 10 people in the room, they can give you 10 different responses, but I believe that interest rates are going to continue to rise. I think we've seen the last of the historical lows, for at least my lifetime, and that increasing cost of capital will start to impact values over the next 12 to 18 months. We're advising a lot of our clients to lock in on refinancing into long-term rates, on terms, if they can, if they don't want to sell. We're also advising a lot of our clients that now is probably the best time to sell before rates do start to rise and start to erode some of the asset value. It's a great time to reposition equity that's been built up. A lot of owners have recouped a lot of their value that was lost in the last recession, making now a perfect time for them to go through and do a repositioning to a newer asset, another market, another area. They want to chase yield, they can come to Inglewood, but there's other markets they can look at as far as trying to chase yield and get a better return on money. New construction, Class A, Hollywood, West Hollywood, downtown, Playa Vista. Probably not a good time to be in those markets owning a large institutional Class A asset, knowing that vacancy is going to start to creep up. Concessions going to have to come out of their pockets to attract more renters. Local government regulation. In the earthquake that happened yesterday, it's already on the radar with the local city government. Earthquake rental fits being discussed. Top parking they want to do away with. Those are issues that for apartment owners we need to be prepared and look at. How does that affect, us? Well, when we're working with a client that's looking to buy, possibly somebody who's in a 1031 exchange, might want to share with him, might want to avoid top parking. That's an issue. And then lastly, the slowing rent growth. Again, it's not that rent growth is negative, not that it's not positive, it's still growing, but albeit at a much slower rate. That will affect owners' ability to increase their cash flow in a rising interest rate environment. That's something to watch out for as well. What we're telling a lot of our clients is start to not so much focus on, continue to push rents to the degree that you can, but focus on operational efficiencies. Make sure that you're reducing your costs and overhead as much as possible so that you're affecting your bottom line, positive cash flow. That's where the focus needs to be. Just like any major corporation, Fortune 500 company, back when they're not selling, what do? They turn inward, cut costs, they cut staff, they cut resources to try to affect or maintain that bottom line. Apartment owners are running small businesses, it's no different. Ben, that's about all that I have. I would like to entertain any more questions if you guys have anything you'd like to discuss at this point. I welcome any challenges on anything that I've said thus far. I'm not the only expert in this industry. A lot of you guys have engaged in presentation, but however, I do take pride in doing a lot of research as I'm more of an advisor, not just a broker to my clients. Yes, sir.
I don't really have I'm not questioning anything you said, you're very well articulate, but I'm kind of working on a funny theory lately that our market is not the typical supply-demand market, that we have a cost push kind of economy where because of costs, things are being pushed in terms of rental rates. This is on the west side, stuff like that. Rental
Right.
rates, stuff like that, just simply because they keep adding costs. I mean, if you're doing development today, the additional costs, they just keep adding.
Right.
So what happens is you get this kind of strange thing going on where if you're in a particular market, I'm running on the west side, and all of a sudden the costs are being pushed up, and they don't seem to be tied to, supply, demand, and some of the affordable questions. What happens is there's just a shifting. The people here, they have to move down. They have other people come in and taking over. So I'm I like your talk, I was curious how you.
No, I agree with you to a large extent. You know, the issue with most owners in pushing rents isn't that they're trying to cover for any additional costs they have to absorb. A lot of it just has to be with trying to recoup what they've lost over the last 5 to 6 years. If they have plans of selling anytime within the next year or two, they gotta make sure they're able to push their rents as aggressively as possible to get that valuation up. So a lot of it's not so much from a cost perspective from the owners, but you know, I hate to say the word greed, but they're in the business of making money. And so they want to push rents as aggressively as they can. But even that has an inflection point based on wage growth. Yes?
I hate to bring up Inglewood again, but I've actually been doing a lot in that area. Secrets out. So you talked about buying B, C class, repositioning, you know, maybe improving it, increasing rents, etc. So let's say I've got a group that bought a pretty sizable property in Inglewood, put a ton of money into it, and they've basically overdeveloped. So getting back to your point of increasing interest rates, increasing cap rates, declining rents, what are the odds that these people are going to buy into these B and C class, redevelop, reposition, and then have overdeveloped for the area?
Well, there's two things. One, first and foremost, you have to do it smart. You know, a lot of people are coming in and they're just either overpaying for the asset, betting on it to come, their whole repositioning strategy and the amount of money they're putting in, they price themselves out of the market. I call it the MC Hammer effect. So you buy a house and you put another 10 million into it, when the average houses in the area are only worth 2 or 3 million. So the improvements have to be tempered with the market and understanding the market trends and what's happening in and around the property. But there's definitely going to be an upside in value in Inglewood. Just a matter of how long we have to wait, when it's going to happen, are we going to get an NFL team? But there are enough things on the radar that are happening today that says that values will increase in Inglewood. That is a fact. Any other questions?
Good job.
Yes, sir.
How do you see, I guess, sort of the constrained traffic and transportation issues, like with trains and like the development? I've noticed, you know, a larger push towards choking out the traffic, pushing more like biker pedestrian sort of situations, whether that's on the west side or more of the Class A downtown sort of environments, obviously Hollywood as well. I just want to get your feel on how do you think transportation is impacting sort of where people live and, you know, rents in different areas? I mean, have you come across that kind of topic or discussion?
Most certainly. Transportation-oriented development, TOD, has also been big in a number of markets around the country, even around the world. It's a proven concept. And as you see in certain pockets, Hollywood, probably the most notable parts of downtowns, where a rail system, again, you got to understand, for a rail system, we're relatively young and new to the market. You go to other established cities, they've been building around the transportation for a number of years. Here in Southern Cal and LA specifically, we're just now coming to the party. So you're seeing a lot more of it. There are a couple of projects up in Pasadena where the rail actually goes through the building. So there are a number of transit-oriented development that's taking place. I think that's the reason why there's so much development downtown, because it affords people to live downtown and work on the west coast, on the west side, without having to drive. So very key point, there's a lot of that. The rail system that's coming through right now from east to west is already in place. There's a new rail system that's being planned down Crenshaw. There's a new rail system that will impact Inglewood, hence the reason why it's so attractive. They're going to be getting their transportation system coming into play as well.
Did you work in Inglewood?
It is one of my markets. I guess I should have said that as part of my disclaimer. It is one of my markets.
There's no more questions. Can you join me in thanking Kevin Mitchell? Thanks, Kevin.
Not a problem.
Good job.
Sally, can you come up and talk to us a little bit? I'll set you up here for a minute. This is Sally Zezet. She's Associate Vice President with Cassidy Turley, and she's got a presentation for us this morning.